Welcome back. Today's journey takes us into the serene world of investing strategies. These 5 strategies will not only grow your wealth but also ensure you sleep soundly at night, and the details are fascinating. Let's explore how a peaceful approach to investing can transform your nights. Our journey begins with the gently flowing concept of diversification, a soothing melody in the sometimes chaotic choir that is investment strategy. Imagine a painter's palette, each color distinct yet harmonious when combined, creating a masterpiece that is greater than the sum of its parts. Diversification works much in the same way. It involves spreading your investments across various asset classes, sectors, and geographical locations. This tactic reduces risk, much like spreading a soft, warm blanket across a chilly night, offering protection against unpredictable market cycles and allowing your investments to ebb and flow without undue stress. Consider for a moment the world of equities. It's 1928, and the height of the Jazz Age has led to soaring stock markets. The allure of quick gains drew many to invest heavily in stocks, creating a cacophony of risk as prices inflated. However, when the market crashed in 1929, those who held diversified portfolios found a more padded fall. It's imperative that investors place eggs in multiple baskets, as history has shown us that putting excessive weight on a single asset can become a source of sleepless nights and relentless worry. The second strategy that cradles you into restful sleep is the tranquil embrace of long-term thinking. Consider it a stroll through a vast lush forest, where every step forward slowly builds a pathway to financial security. Long-term investing allows market fluctuations to settle over time, easing the need for frenzied reactions to short-term market volatility. The history books are filled with stories of those who sowed patience and reaped rewards. Picture the year 1974. It was a challenging time for investors with numerous economic obstacles like stagflation and the oil crisis. Yet, those who adopted a long-term perspective, investing consistently through thick and thin, often found themselves reaping benefits in the following decades. The famous example of Warren Buffett buying shares of the Washington Post Company in the early 1970s exemplifies this. Despite short-term economic turmoil, Buffett's steadfast commitment resulted in exponential growth for this investment years later. Shifting our focus, the third peaceful strategy involves the gentle power of dollar-cost averaging, a method akin to planting seeds across seasons to create a stable, nourishing garden. It involves investing a fixed amount of money at regular intervals, regardless of the current price of the investment. This technique serves as a calming mechanism against market turbulence, reducing the effects of volatility over time and aligning well with those seeking tranquility in their financial journey. Envision the 1990s. Technology was revolutionizing industries, yet markets were wildly uncertain, a landscape littered with both opportunity and peril. Investors who routinely set aside small amounts of money for investments like index funds enjoyed the rhythm afforded by dollar-cost averaging. They bought more shares when prices were low and fewer when prices were high, thus capturing the essence of peace through consistency and routine, avoiding the sharp anxiety of trying to time the market perfectly. The fourth strategy, asset allocation, is a graceful dance between risk and reward, similar to balancing on a gentle beam. By adjusting the proportion of different asset categories, such as stocks, bonds, and cash, investors can tailor their portfolios to fit their individual risk tolerance, time horizons, and financial goals. This technique promotes a serene financial landscape, insulating one from drastic market ebbs and flows. Imagine the world of finance in the early 2000s. The dot-com bubble had burst, and the landscape was as changing as the winds. Intelligent asset allocation decisions during this period, particularly the inclusion of bonds and alternative investments, provided a cushioned ride, preventing portfolios from plummeting into the depths of despair. Those who embraced this strategy understood that allocations might need adjustments over time, adjusting sales to better weather the winds of change and maintain equanimity in investing. Our last strategy focuses on the calming practice of maintaining a robust emergency fund, a financial sanctuary akin to a serene natural refuge in a bustling world. An emergency fund acts as a buffer against life's unexpected events, providing liquidity and peace of mind in turbulent times. Recall the financial turmoil of 2008. The global financial crisis had left many scrambling for liquidity as markets crashed and job loss plagued the masses.
Those with a solid emergency fund equivalent to 3 to 6 months of expenses found they could navigate the tumultuous waters with a sense of calm and security, ensuring that pressing needs were met without the need to liquidate long-term investments at inopportune times.
As the years drifted onwards, a certain tranquility enveloped those who embraced these thoughtful investing strategies. Their nights were undisturbed, much like a placid lake under a starry sky. Yet another pivotal method, rebalancing, entered the frame here, a subtle fine-tuning of one's financial ensemble. With time and market fluctuations, the initial asset allocations would inevitably change, like the shifting of sands in the desert. Rebalancing was the prudent act of realigning the portfolio to its original or updated allocation targets, ensuring that one's financial compass remained true and clear. Consider the tumultuous years following the financial crisis of 2008. As markets began their slow and steady recovery, portfolios that initially leaned heavily on bonds and cash witnessed a natural shift towards equities as stock markets gained momentum. The discipline of routine rebalancing allowed these investors to systematically sell high and buy low, thereby maintaining their intended level of risk and providing a sense of structure amid market uncertainty. While the inertia of recovering markets might lure some into complacency, those who adhered to rebalancing sailed smoothly, avoiding the potential pitfalls of an unmonitored portfolio drift. Alongside rebalancing stood the philosophy of diversification, a timeless principle that sought to spread and minimize risk, not unlike planting seeds across many fields to ensure a bountiful harvest regardless of weather whims. By holding a mix of asset classes, sectors, and geographies, diversification reduced the impact of any single underperformer. When economic tremors struck specific industries or regions, a diversified portfolio cushioned the blow, much like well-designed buildings that withstand the mightiest earthquakes. In the early 1980s, for instance, investors who diversified beyond their national borders uncovered a trove of opportunities in emerging markets like Southeast Asia and Latin America. Growing economies and burgeoning middle classes sparkled like buried treasures, contributing fresh growth potential to otherwise familiar portfolios. While some economies encountered setbacks, others thrived, showcasing the protective power of diversification. By 2010, a growing awareness of socially responsible or ethical investing began to shape emerging strategies. Investors started looking beyond mere financial returns, seeking investments that aligned with their personal values. This approach was a symphony of both financial prudence and conscientious stewardship. Socially responsible investing, SRI, involved selectively investing in companies that championed environmental sustainability, social justice, or corporate responsibility. The tragic Deepwater Horizon oil spill of April 2010 served as a pivotal moment, highlighting the severe repercussions of neglecting environmental consideration. It also illuminated the potential hazards of having investments intertwined with companies that ignored sustainable practices. Ethics-conscious investors watched how such disasters resulted in plummeting stock prices and reputational damage, reaffirming their commitment to choosing companies with responsible business practices. The pursuit of these ethical investments did not mean sacrificing financial performance. Rather, it was a harmonious blend of achieving lasting returns while fostering a sustainable future, crafting a legacy of stability for generations to come. Investors who grasped the essence of this balance found solace in knowing that their financial contributions resonated with both their wallet and their worldview, crafting portfolios that were as morally robust as they were financially sound. In exploring the gentle art of these investment strategies, an overarching theme silently permeates the narrative: the cultivation of patience and discipline. Investing is an endeavor tied intrinsically to the passage of time, where the seasons of gains and losses unfold like gradual waves rather than sudden surges. The patient investor, akin to a seasoned gardener, views short-term volatility as noise, focusing instead on the slow, steady growth of a well-tended garden. The wisdom of time, applied with consistency and patience, valued staying the course through transient market vicissitudes. The global impact of the COVID-19 pandemic, emerging starkly in early 2020, once again underlined the importance of patience. As economies shuttered and markets reeled from uncertainty, those grounded in patience and sound investing principles witnessed the eventual recovery of markets, which not only reclaimed prior losses but soared to new heights undetected during the stormiest years. With such strategic foresight, the narrative moves towards a closing reflection. These outlined methods, from the structured rhythm of dollar-cost averaging to the ethical reflections in SRI, each offer an individualized path to cultivating financial peace and security. These strategies span the gamut from the mechanical precision of rebalancing to the empathetic nuances of embracing socially responsible investing, all rendered invaluable through the steadfast lenses of diversification and patience. In an ever-changing world, grasping these diversified approaches fosters an oasis of calm and satisfaction for investors. Much like a weaver deftly crafting a tapestry, these strategies intertwine to form a sturdy canvas that supports and secures one's financial ambitions. The awareness and implementation of these principles empower investors to weather the ebbs and flows of financial tides, with minds at ease, ready to rest, sleep, and dream of prosperity under the vast, serene expanse of the investing universe.